Are we about to head for another watershed sell-off moment in markets? Hello, ladies and gentlemen, and welcome back. Well, we are witnessing history going on right now. The Federal Reserve is saying we need to combat inflation, but at the same time, the market has totally freaked out. Last week, we were sitting with December 2023 rates at 5.5% plus. This week, 3.88%. These are truly history-making moves. So with CPI print coming out in less than 24 hours, what is going to happen to these markets? Well, we've got the key levels for stocks, commodities, and cryptos coming up. Let's talk about everything, including our regional bank crisis thoughts. Well, welcome back, everybody, to the Daily Show where we talk about markets around the world. We've got the macro, lead news, key levels, and of course, all the hottest charts coming your way. I want to begin here because I think it's a great chart for us all to discuss. There were 0 US bank failures in 2021 and 2022. Now, the last time we had 0 and 0 was actually 2005, 2006. Does that sound familiar? Well, for a few of you, it may. It was actually before the global financial crisis. Now, why are so many people concerned about these banks right now? Well, it's not just Silicon Valley Bank. It's obviously a lot of small institutions which are having bank runs on them right now, where depositors are scared and running towards the larger institutions. But it also has to do with potential contagion, with financial firms actually sitting there with held to maturity bonds that are not sitting on their financial statements. But these are losing positions. So they're not going to sell them and flag it to the regulators. But it looks like the big four even have a huge amount of exposure to this. So whether it's Bank of America, whether it's JP Morgan, Citi, or Wells Fargo, you can see the unrealized losses on these bonds are quite large. We also do know that there's been a bank term funding program. If you want to pause the video here, you can have a look over that. But realistically, we knew that something would break. It just so happens that it's zombie banks rather than zombie businesses at this stage. And this is what happens every single time. When the Federal Reserve embarks on an interest rate hiking period, they break something and then they have to cut rates. But will they cut it as fast as the market needs it? This is where the disconnect's going to happen. The market expects incredible rate cuts, but the Federal Reserve is having to combat inflation. And if they don't rate cut the way the market wants to, expect some serious divergence between prices currently and, of course, the expectations in the future. Now, we've warned against this quite a few times that eventually this may occur. It's happening a little bit faster than maybe some have been seeing, but this is a curve here where we have an inverted yield curve versus a non-inverted yield curve after the last Fed hike. So a lot of people are speculating now that there's no more Fed hikes to come. In March, we expected 50 basis points last week based on what everybody else was talking about. If you look at Goldman Sachs, JP, everybody else, they all said 50 basis points. In fact, it was like 86% chance of that cut, or that hike in this case. But now we're getting a chance of a pretty serious, not really cut, but maybe only 25 basis points or maybe 0 basis points. And most of you in the comment section will say it has to be 0. They have to pause it now. Well, when they've paused and we have inverted yield, we know what happens to markets. They tend to underperform. We also know that this is where the yield curve stands, and it's pretty messy at the moment. The chart that we're actually looking at here is this bottom one where we see this blue line. So last week, we're basically up here sitting around 5.6, 5.7% terminal rate. All looks pretty good. Curve and then higher for longer. This week, look at the difference. Basically, where we're at right now, maybe 25 more basis points, then cuts all the way through into 2024 and all the way through to 2025, and we're sitting at 2.5%. That's a massive shift. To go from cutting to 4%, now cutting to 2.5%, the market must believe, at least the bonds market, that something is incredibly broken in the system. And I doubt it's going to get this much support from the Federal Reserve anytime soon. It seems unlikely the Fed will want to cut like this, but of course, we've been proven otherwise. One thing we do know is that the Federal Reserve generally doesn't like to move too quickly on anything. You know, think about inflation. It was transitory for a long time, then they started doing it. They tend to only do the cuts when they're pretty sure of something occurring, and it tends to be late. So in this case, if they're going to stick to their guns, they'll continue to do rate hikes until they deal with inflation. and then they'll pause, then they'll hold, then they'll cut. The market wants more. And if the market doesn't get what it wants, it throws a tantrum. And the tantrum is probably going to be the most scary part of the markets should this be the occurrence. So, of course, CPI print will be very important. So what you've just seen here is a 3-day massive sell-off plunge. In fact, it's one of the biggest in recorded history. And you can see here the global financial crisis where we got those reads. So very interesting, we got those reads. Notice what happened afterwards, a watershed moment. If we have a look at COVID and see what happened during this period over there, we can see that there was still further sell-off to come, but it was close to the lows. So this type of thing has happened before, and it's usually a mass freak out in the system. It's basically not peak fear, but certainly a lot of fear coming through. We also saw a surge in 1 month lows on the S&P 500 financials. You can see here over 90+% of all financials were hitting new 1 month lows. Makes sense. Of course, most of them are suffering some of the same fates. And then we saw here S&P financials, once we've seen this switch with an S&P 500 return afterwards. So when we've seen this over the last kind of 3-4 decades, we've generally been near or close to kind of those low periods, but we still have a very tumultuous next couple of weeks. Notice here, 1 day later after we got these reads, not so good. A few days later, not so good. Even 21 days later, only 67% of the time we were positive. So definitely a kangaroo style market, possibly even a little bit more sell-off market could be coming this way. But what about if we look past that data and we go even further? What about 1 week, 2 weeks, 1 month, all the way up to 12 months? Well, again, very, very dodgy for the next 6 months is the way that we look at markets. Remember, markets are inherently bullish devices. So if we're seeing stats that show less than bullish kind of sentiment, e.g. in those 60s or 50s, that usually means a very kangaroo style kind of read is happening here. Now, we have seen this near the end of certain crisis periods like 2008, similar kind of reads. And if you believe that the bottom's in, this is going to be a very interesting time for you because, of course, if we get down to those 3750s and some other key levels that we look at, there could be some interesting buys for, of course, people that like to hold things and like to buy the fear. What about dumb money versus smart money? What have they been doing? Well, a few months ago, we brought this up and people thought, oh, the smart money is really stupid. Well, remember, smart money tends to sell into the rips and buy the dips. So no surprises that smart money inflow increased over the last 24 hours. They're going to buy the dips. That tends to be the way that it works. Now, this indicator also shows you that over the last 24 hours, retail traders also sold off even more, obviously freaking out in this market. And that's something interesting to definitely take into account. We also have here US equities following the no recession path up until recently. Now they've started dropping down. The reason I brought this chart up again is just to show that generally when we've had a recession, markets actually have made a new low historically. So we haven't seen a new low. That would push in a 3,500 and below. So we're going back down to the 34s. And some people expected at the beginning of all of this that eventually we would trundle our way down to 3,000 to 3,200. Now we're not there yet, nor have we broken through the key levels of 3750 properly and some of the big zones there. But we will be talking about some of the key levels should we see a watershed style moment today. We also know that markets aren't allocating a lot of risks towards EPS growth or any of those things. We saw those turn negative recently, yet stocks are still being valued above their forward PE ratio averages. That's a big deal. And of course, something we're looking at. ERP is also a big deal. If we're going into recession, Mike Wilson obviously talked about this from Morgan Stanley. And he said, look, ERP usually rises, which is risk, basically in stocks compared to other asset classes during a recession or leading into a recession. Well, up until recently, we've had absolutely none of this. So will we start to see it? Again, it materially rises around these times. Now, this is the crux. Realistically, you might say, well, okay, that's fine and all. I'm freaked out in this market. I'm not buying anything till I get my price. The problem is the system's broken. And I think we all know this. And I talked about it in our Monday live stream where we discussed the idea that the Federal Reserve realistically has been pushing the envelope for a long time, ever since really the global financial crisis with monetary policy. Now, at the moment, they're pulling back on assets. So they're basically tapering. In the last 24 hours, I have seen an increase in liquidity being injected into the system. Now, if that increase continues to stay around and we keep dropping and the liquidity comes up, make sure to subscribe because I will be talking about it on this channel. If that continues to happen, you've got to generally follow with the Fed. You can't follow against them. So if we're seeing those liquidity readings come through, it could be another case of the markets being supported by basically policy that will eventually be the undoing of us. But for now, it's what we've got to do. Don't fight the Fed, as they say. So when the Fed pivots, we've seen historical crashes in the past. It's not a great word. Remember, pivot doesn't mean good things. So if the market goes up based on pivot, well, historically, that's not really been the way. So, of course, rallies could be faded here based on the news that we're seeing, the contagion, and this is probably just the tip of the iceberg of things that are truly breaking in this system. When we move over to the day and what we saw, well, I was happy in some ways and sad in others. Of course, if you were in regional banks, you were pretty upset. At one point, they were down 16% during the open. That was probably a bit too much for the session. That's why they did stage a recovery. They went limit downs, got closed, all sorts of things. But then we saw the rise of some defensive sectors. So there's a lot of stagflation style sectors started coming out. Gold, in particular, 7% up. I've said it before, when yield curves get crushed, gold will do well, and it had an amazing move on it. And a few of you guys caught that. I saw it in the comment section. If you're listening to what I've been saying for a long time, I do understand gold pretty well. Well, it was a nice run. And yeah, I think it's probably moved pretty heavily. It could still move. Obviously, my medium term, that is 5 years away. Long term, we'll call it long term, is probably $3,000 an ounce for gold. But at the moment, I think that was an exceptional move, over $100 an ounce. That's a big deal. Bio moved up. You might say, well, how does bio move up in a day that's pretty bad for markets? Because they make no money. So when you cut rates, that's going to be a good thing for bio. And bio particularly was suffering. So yeah, high rates, not good for businesses that literally make no money and need lending. If we have a look over here at utilities, healthcare, and staples, they were some of the better performers on the day. We've been talking about them now for a while. And if we look at the 5-day average roll, you can see, again, the ones that are up are the usual defensive suspects. Staples, utilities, gold. Whereas over here, regionals down 25.83% over the last couple of days. Historical moves in a historical market. If you're interested in keeping up with this massive stuff that's going on, make sure to come over and follow us on our socials. Definitely join over on our TikTok as well. And do remember, we're doing a giveaway for March, completely free. Links in the description down below to click here, and then you can sign up for that. We'll do the launch or do the prize draw next week, probably during our live stream on March the 20th for the open there. So if you're interested in getting a couple of prizes and potentially winning, then you can go and check that out. It's totally free to enter, and it's our way of saying thank you to you in the YouTube universe for watching the channel. Let's move over to the VIX. So we saw VIX spike 30. Now, if anyone's been watching this channel for a while, you know I really like 30 plus. So if 30 plus happens, I feel good. If 45 plus happens, I feel greedy. So what that means is, of course, they call it the fear index. And yeah, we've had some big readings in the past. You would probably remember 2020 when we hit 85. That was certainly a massive time. The only other time I remember that was the GFC when I first started. And then if we go through here, we can see there's been a lot of 40 plus readings during max fear. I do tend to like the old 45 pluses and the 40 pluses. When you get those, usually it's a period where you should be looking very much at your technicals and making some assumptions about what you believe is happening. But remember, markets can't fall in this current environment the way they used to. This type of news, what we just saw in the last 24 hours, without the Fed being accommodative, seriously would crush markets. And it did crush them, but nowhere near as much as you would usually see. Let's move over here to December yields. If you have a look at December yields, check this out. 35% switch since last week. That's amazing. That is a huge crunch. And I think it's an overreaction. I doubt very much the Federal Reserve will accommodate that. But you never know. It could be based on inflation dropping at an absolute historic rate. This is huge, though. To think that this is going to be supported by the Fed, I don't know. I don't think the market's going to get what they want. Will they throw a tantrum? Let us know in the comments down below. What do you think? Do you think the market's going to throw a tantrum at the Fed after the CPI print and after the March meeting? All eyes are going to be on that March interest rate meeting. If the Fed come out and say, we're going to do another 25 basis points, I think the market's going to crack it, and we'll find out whether it does or not. Over here on treasuries, we saw a pretty nice open to the session. Obviously, we know banks and other people are selling treasuries at the moment because they're forced to. At the same time, with yields curving down, we expected this rise in treasuries. Really nice kind of take profity zone if you were trading it. I don't usually suggest trading treasuries, but beautiful level, and certainly treasuries there. Now, we still have a super critical level. I'm looking for that zone, 109.58, to be closed above for treasuries to show that treasuries are on the move to the next level of equilibrium, being 118, 120. If we continue to see yield curve shifts like we're seeing at the moment, treasuries should do okay. What about bonds though? Well, theoretically, corp bonds should do okay in a session where you have massive rate cuts and quality corp bonds should theoretically go up. Well, yes and no. I mean, they should, absolutely. But at the same time, we're probably seeing regional banks and other people having to sell some of their long date corps. So I think it's a catch-22 here in the corp market. I don't particularly dislike bonds right now. I think they're all at fairly decent values. But it just shows you here, look at that. That's the risk coming back in. So in comparison to treasuries, we were actually down on this day, or basically flat on corps. And if we take a look at high yields, which you would think, well, they might do okay because, of course, again, we're seeing rate cuts. There was new lows being formed. So these are warnings. New lows, very nasty looking high yield. If we see high yield bonds continue to drop, that's junk bonds, by the way, be scared because, of course, that's the type of thing that starts a roller coaster in markets. If you see the bond market crashing, especially high yields, that's not really great for economic health. So this is where we're witnessing history, guys, and you are witnessing history. Look at this epic sell-off. It only has happened a few times in my trading career, 2020, right now, and of course 2008. We haven't seen sell-offs like this in regional banks for a very long time. And what I think is interesting about this is we actually almost filled the gap that I mentioned on the weekend within one trading session. We ended up as what we call a long leg doji. So that means it's indecision. The market's confused about the next direction it wishes to go. And why wouldn't it be? We've got the CPI print coming out 1 hour before the market opens. That's the inflation print. This is a pretty serious deal here in terms of what's going on with the banks and what's going on with the regionals. I do think that you'll find that oftentimes markets will bottom with the regionals. So if you have a look at some of the previous times, remember financials do run the sectors a lot, do run the market. So we had a drop off in regionals over here during 2018. As they started to recover, markets recovered. Again, a massive drop off here during 2020. As they started to recover, markets were putting in the low. We had the low over here without getting a low in the regionals. I remember looking at that and thinking, well, maybe this is a buy opportunity. And here we have an absolute collapse on new ones. So will that start to actually trickle through into contagion of the market? Generally speaking, when we've seen such a collapse in regionals, we're making new lows on the S&P. So it's an unusual time, especially just to see so many tech stocks and other things hold up, probably due to the yield cuts across the board. So what about US dollar? Well, US dollar is a safe haven, sure, but it hates these interest rate cuts that are being projected. So, of course, it's continued to weaken. And at this point, unless the yield curve switches up, we can't really see much strength for the US dollar just yet. So we hit kind of like a mini critical daily level here. We've gone through the key zone here, which means we've got the high, low, higher, high. It hit into our super big resistance zone recently, which is where we thought the bearishness would come back in with the DXY. The data supported that. And now I'm looking for some kind of rally switch at some point in the future. Now, whether it's here or here, I don't know yet. But I do think that the dollar will go to 2 sold, and then it will need to get a bit of a relief rally in it. So we're looking for relief rallies. At this stage, I'm looking at this 104.84. I haven't seen any signs that the dollar is putting a rally in yet. We need to see it breach past some of these other areas. So something like taking out that 103.96, that could be a nice first start to say, okay, now we're moving to 104.84. But at the moment, you can't bet on the US dollar just yet. It's just not going to look so good with these rate cuts. What about gold? Well, congratulations if you got into this one. Yes, rate cuts across the board. Very good for gold. It's had an exceptional move, $100 an ounce move. That's huge. I do think it'll probably run out of some steam somewhere in this next kind of $50 an ounce. I haven't seen any real signs of it dropping just yet or anything like that. So again, you've got to be careful. It's still on the roller coaster up. It can keep going. we've entered into what I'd call like a little order block over here. So basically it's in supply. We could see sell-offs here. It's certainly a critical zone. I'd be looking for little turns if I was a scalper. Otherwise, don't fight that trend. That trend is very strong, and the more the yield curve drops off, the better gold's going to do. If it keeps getting trashed, especially after CPI, then it's critical. But notice where we are. We're here ahead of CPI. So probably CPI is going to mess around with this one quite a lot. Copper made a new low, couldn't close below it. So this is the 3.93. I consider that a critical level for copper and just wasn't able to get underneath it. So we'll come back to this chart over the next couple of days. What about US oil? Well, still stuck within the range. Daily was pressuring the downside. US oil hates rate cuts, so certainly not good for energy stocks across the board. And if we close below this 73.20, I believe we're moving to $65 to $60 a barrel. So at this point, still stuck in the range, doing nothing much. This is where things got pretty sweet. I did mention this in the live stream last night. You know, you guys nailed it. We nailed it. So natural gas absolutely went bonkers off that 246 level. If you watch our video on the weekend, it almost pinpointed it, which is kind of nice to see. Now, you don't always get the absolute perfect level, but yeah, that was a perfect level. So it was pretty nice to see. Certainly a nice little bounce. Now, natural gas is always called the widowmaker, so it's very, very volatile. It was a great session for it. I could see it still stuffing around, so you've just got to be careful, but that's exactly the type of pullback that we expected, and we saw a nice bounce off it, which could show that, yes, the bottom is in for natural gas, but remember, this thing moves 30% in one day sometimes. So be prepared for serious moves if you're ever going to touch that thing. Let's move over to Tesla. Minor support was bounced. So this is that 160, 164, 165, 166 area. We had a little box here. We've always thought this is where rallies could resume. I still think that this is very possible, which is the 145, 150 range, to fill that gap that's down here and to pull back. So we talked about the idea that this was a huge rollover over the last couple of weeks. We talked about it being a Wyckoff distribution. So far, so good. And the market's come down. Maybe it's time for a bit of relief rally. It really comes back to the market and whether the market wants to do that. If we look at the options for the week ahead, this is the third week OPEX, the quad witching. We'll talk about it. Thursday is going to be a very volatile day as well. So we've got Tuesday morning volatility, Thursday extreme volatility with all the options going on, and then Friday might simmer down a little bit potentially. However, here we've got the $200 calls, probably going to make no money there, and we've got a lot of calls at 180 appearing out of nowhere, 37,000 units, and then of course the puts at 170. So look, people are placing put and call bets on Tesla. I think it's pretty even now, and we're seeing calls even at 135. So I wouldn't say options are giving us any edge this week on that chart. Apple stuck in the middle of the zone, very strong stock, ended up 1.33% considering I don't really like anything about Apple. It just looks like it's in the middle of nowhere. Nvidia, now this one pressured the lows. So remember, we have a gap up and we have a build of whatever position it is. If we have a gap down, what is that? An island reversal. So AI has been the hottest hot, but will they now say, well, it's a little bit overpriced? Well, price action is going to show us that. So remember, if we get gap down, that's an island reversal. Very interesting level indeed. If we move over to the XJO for the Australians, we'll go through the indices now, including the major USs. Then we see here that we've got 7,000 being hit by the Australian market. Can't say this was unexpected. This is exactly where I think the markets should have come back to for Australia. We have a lot of banks. So whether it's the DAX, the FTSE, the Australian market, it doesn't matter. These international markets have lots of old economy stocks, banks, energy, and then, of course, we also have materials. Now, materials might do okay, but energy will not usually do well in these cut environments unless it's stagflation. And banks obviously coming under a lot of pressure. Here's the DAX over the last 24 hours. Take a look at this move. So from top to bottom, we moved to almost 4% in a day. You know, remind you of something. Well, we haven't seen a move like this since over here. And realistically, we haven't really seen the DAX come under pressure for quite some time. So new low was formed. Take a look at that. Just a little new low. If this comes back and ends up closing below in the next couple of days, it could spark really bad things for the DAX. I wouldn't be surprised at all to see it do this, But yeah, at this stage, big new low, change of trend, rallies probably met by sell demand in the DAX market is how I'd look at it. US 2000 putting pressure on the low end side. These are the small, a lot of banks, a lot of regional banks in the Russells, so got absolutely destroyed on the day. It's at support or demand coming into inflation. Makes sense. We're at a key level. What about the options, or sorry, the Qs? These options actually set up incorrectly. I don't know why I've got those. Check out our Twitter to have a look at the options levels. It mustn't have refreshed. But basically, we saw a rally, and then near the end of the day, it sold off. Now, notice these highs. So if we actually go to, well, first I just want to show you all the monthly, just so you can see the monthly. Still very nasty monthly, big shooting star rejection at the moment, a continuation. March's close is going to be a big deal. But let's have a look now at the futures. So it wasn't actually that hard for sellers yesterday. It was pretty much just sell this area. So if we're selling this area through the Asian session and the US session, that's where the bears sit. It's clear. It's clear as day that the bears sit here. We end up getting a new low. So we have a low, we have a high, we have a lower low. Now we're looking for a higher high. We get a higher high, we probably switch to the upside temporarily for now. So inflation is going to be a big one. We're sitting in the middle of the zone. We know that the downside could be worse, and the upside, we're looking at how it interacts with this zone. There's going to be stop losses behind here. So if we get news, it goes like that, be ready for further sell-offs. If it comes up and closes through, get ready to buy the movement in terms of the technical analysis anyway, in terms of how it's going to set up. So critical zone here at 12,070 to 12,100, big level. SPX, let's move over to the big one. This is the very important zone. I believe between 39.50 and 39.80, huge amounts of orders sit, huge amounts. We're talking 6 months of aggregate positioning from Wall Street. What else sits there? A 200-day moving average. Does this daily candle close fill you with confidence? Not really. It's basically a big doji. Lows, highs, opens and closes all at the same level. So this is super critical. We filled one of the gaps. We'll call it close enough. So we filled one of the gaps. And we know that during the CPI print, there is a potential chance that the markets could dip and move underneath to clean up the 37.50 gap. Now, I said we'd talk about all the key levels. So if we go into a watershed moment, the way I kind of see it is still this would be bought. Then we could potentially sell off even further if things got worse. This is a serious gap and serious confluence zone. I can see a lot of buyers recommitting there. And if we get through there, well, then we could go all the way to 3,200. So the key levels moving forward are going to be 37.50 to 37.83. We're also looking at very key levels around this very important zone of 39.50, 39.80, and the 200-day moving average. These are super critical zones. Everything in here is kind of like questionable no man's land, at least on the SPX. See what you guys think in the comments section. Always interested in your comments. This is the expected weekly options highs and lows for the market. So you can see here the key levels moving forward, where we're at, where the volume's at. Big volume last couple of days. No surprises, of course, it's going to be. And now we move over to the futures market. So there's a lot of lines here. So first up, what do we know? Well, the S&P is way weaker than the NASDAQ, clearly. I mean, it has the banks, it has the old economy, and yeah, those areas are getting absolutely wrecked at this stage. We also know that this was the Asian high support, resistance or supply. So basically, this is a super critical zone, 39.30-ish level. And I still think that if that ends up getting bounced up here between 39.50 and 39.80, that zone we talked about before, is probably where you see the sell-off recommence. And then possibly you might see buys, because what just happened in the last 24 hours is pretty big. So we've gone to a lower low. We have our highs. We have our lows. We're looking for a switch here. And then we could do this, this, and that. So that's one. That's the bull case scenario. To see this level get taken out is going to be a big deal. At the time of this recording, we're sitting at 38.65. So obviously still quite weak on the markets. And you'll notice that I've kind of tallied in some big levels. I had the major confluence zone. We have this little low here. We have the close of the first gap. These are all good levels. And I liked anything really from 38.50 from a swing trader to 37.50. Why? Because there's so much confluence and so many potential orders that could come in through here. But CPI is going to clean this up. The extreme low, I believe, is here, 37.50. Now, if the extreme low is broken and closed below, ooh, 35.80, 35.80. But at this stage, I think this is where sell-offs get met by serious demand. And I could see why the market bought this low in previous session. If you have a look 2 hour, you can see it. Let's take a look at the daily here. Again, holding above this zone with wicks. So because it's a high and a low and literally a long leg doji, it has absolutely no direction. You have to assume the trend is currently down. There's no switch. If there is a switch, we'll update and talk about it on this channel. But at this point, there is no technical switch towards bullishness. It is only bearish on these charts until the CPI sorts us out. So yeah, we are in a critical zone, and this down here is what I would call the extreme, and that's the super extreme of this current move short. So big deal there. Now, a lot of people will point to options and say, Tom, it's not possible that markets can't go up based on these puts coming into the OPEX. So I'll just refresh this again. We'll go to the 17th, and you'll see all the puts coming across the board. Look, there's a lot of puts. Remember, Wall Street's been making a lot of money. So you don't know whether Wall Street's puts or not. You don't know who they are. This week, I'm not using maximum pain. You can if you wish to. I'm just choosing not to because we have got fundamentals taking over. So sometimes you use it, sometimes you don't. Obviously, third week is always a week I use. There's 5 million plus options outstanding. That's a huge deal. If Wall Street's to make the most amount of money, theoretically, they'll push the markets up. But I do think we're fundamentally driven here. And this is basically a fight between the Federal Reserve and the market. Is the Fed going to hold their ground or not? Well, the market's asking for a lot of support based on the yields and probably an overreaction on the yields. Let's move over to Bitcoin. This chart, it looks shake. I don't trust this one. It's moving like gold. Yeah, I know digital gold and such. It's probably moving off growth stocks more than gold. I don't think it's a hedge against the banking system personally. I know some of you are going to disagree with me, but if you're a bull, you're looking for it to go past 25,200. I wouldn't have picked this thing to rally this much. So yeah, I mean, Bitcoin's obviously very strong on the charts, big volume, all of that type of stuff. I can't say I trust this move. For me, it's just I'm chilling and just waiting for the key levels. Like I always have been, I'm just chilling here on Bitcoin, waiting for key stuff. And that's often what I do with the technicals. I like to be very consistent at looking at extreme levels to act on. And at this point, Bitcoin, that's a big move, possibly too much for it. We also have, of course, all that stuff going on in the cryptoverse, which is the stable coins. So again, Bitcoin, not really, the whole ecosystem is not really filling, I think, a lot of new people with confidence. And that's a problem because you don't have more inflows from at least the standard retail traders. Let's move over here to core CPI. We know that comes out 1 hour before the market opens. So this is going to be a big one. Inflation expected to drop. Will it? If it stays hot, the market's going to hate it, you would think. You would think, because that will force the Fed to go higher. I think in this case, a hot CPI is a very bad sign for the market. But what do you think again in the comments down below? Then we have core retail sales and all of that information coming out on the Wednesday. Then we go to the Thursday and we've got the ECB press conference, so a big week here. And then prelim UOM consumer sentiment on Friday. So it's a big week across the board. If you haven't already and you enjoy the content, subscribe, smash that like button. And of course, click on the links down below and follow us on all our social medias. Get some free cheat sheets if you're interested. And of course, we're doing the March free giveaway as well. So check it out down below if you're interested. Thanks so much for watching. Thanks for your time. We'll see you in the next one. Good luck out there. Practice risk management whenever possible, guys. It's a very dangerous zone right now. Bye for now.